Imagine a classroom with no walls, no textbooks, just timeless wisdom being shared across decades by two of the greatest financial minds the world has ever known. This isn't fiction. For over 30 years, the Berkshire Hathaway annual shareholder meetings became a one-of-a-kind masterclass led by Warren Buffett and Charlie Munger, where thousands gathered, not for quarterly earnings, but for insights into life, business, and decision-making. While others chased trends, this duo built an empire grounded in patience, reason, and long-term value. And those who listened closely? They didn't just become better investors, they became wiser thinkers. Warren Buffett once said, "The chains of habit are too light to be felt until they are too heavy to be broken." Munger added, "Spend each day trying to be a little wiser than you were when you woke up." These aren't just clever sayings, they're the guiding philosophies behind a lifelong framework for rational thinking. Through stories, questions, and deep reflection, Buffett and Munger built what many call the ultimate mental model for long-term success, not just in finance, but in life. They weren't selling stock tips. They were teaching how to think clearly in a noisy world. Their system emphasized the power of patience, the discipline to ignore hype, and the courage to stay calm when everyone else panics. Think of it like tuning a mental radio. Buffett and Munger taught how to tune into signals and block out static. Instead of chasing quick wins, they focused on value. What is this business really worth? How does it stand the test of time? Just as a craftsman selects the right tool for each task, they used mental models from multiple disciplines, math, psychology, history, to guide decisions. So, ask yourself, are you reacting to life's chaos, or responding with clarity? Are you measuring success by fleeting applause or lasting substance? In a world driven by speed and distraction, the Buffett-Munger philosophy is a reminder to slow down and think deeply before acting. Their lessons prove that success isn't built in bursts, it's built in layers, like compound interest on wisdom. Now it's your turn. Whether you're an entrepreneur, investor, or lifelong learner, this distilled blueprint from Buffett and Munger gives you the tools to navigate uncertainty with conviction. If you want to grow your money, grow your mind first. Embrace long-term thinking. Prioritize clarity over complexity. And remember, true wealth isn't what you earn, it's what you understand. About the author. Daniel Picot is a seasoned investment advisor at Picot & Company, who has considered Berkshire Hathaway's annual shareholder meetings a cornerstone of his lifelong learning since 1984. His in-depth analyses of Warren Buffett and Charlie Munger's philosophies have gained national attention, earning features in outlets such as the New York Times and Money magazine. Corey Wren, also a partner at Picot & Company, brings first-hand experience from his time in Berkshire Hathaway's internal audit department, providing unique insight into the inner workings of one of the most respected companies in the investment world. Key takeaway 1. Buffett and Munger's number one rule: why price means nothing without value. In a world where millions of people obsessively track stock prices each day, few stop to ask a simple but vital question: is the price I see truly the value I get? Warren Buffett and Charlie Munger, two of the most iconic investors in modern history, argue that most people confuse price with worth, and that single mistake can cost fortunes. As Munger once quipped, the big money is not in the buying or selling, but in the waiting. Your first lesson in mastering long-term wealth begins with separating noise from signal. Their guiding light traces back to their mentor, Benjamin Graham, who famously said, "Price is what you pay. Value is what you get." According to this philosophy, every investor should aim to calculate a business's intrinsic value, then patiently wait for the market to offer that business at a steep discount. This concept is more than math, it's a margin of safety, a cushion built not just for mistakes, but for the unpredictable swings of the real world. Think of it like designing a bridge that can carry 30 tons, even though your trucks only weigh 10. It's not excessive, it's smart risk management. To navigate the ever-shifting stock market, Graham introduced the allegory of Mr. Market, your manic-depressive business partner. Some days, he's euphoric and overpays. Other days, he's despondent and sells at irrational lows. Buffett and Munger's genius was in treating Mr. Market not as a guide, but as a servant. When he offers you a foolish deal, you don't react, you wait. Because investing, they insist, isn't about IQ, but EQ, emotional discipline. As Buffett once said, be fearful when others are greedy, and greedy when others are fearful. But their thinking didn't remain frozen in Graham's era. While Graham focused strictly on balance sheets and hard assets, Buffett and Munger evolved the strategy. They began weighing intangibles, things you can't touch but can't ignore, like visionary leadership, consumer trust, or brand dominance. These intangible traits often tell a deeper story about a company's staying power. For instance, why is Apple worth more than its factories? Because its brand loyalty is priceless. In today's market, business quality is the new balance sheet. So, if you want to think like Buffett and Munger, stop obsessing over what the stock market is doing today, and start asking what a business is truly worth. Practice patience. Cultivate your temperament. And remember, real investing isn't about predicting the future, it's about being prepared when opportunity knocks. If this lesson resonates, get ready, the next chapter will build on these mental models to help you develop your own enduring investing edge. Key takeaway 2. Buffett's big shift, from cigar butts to billion-dollar brands. Imagine picking up a soggy, half-smoked cigar off the sidewalk just for one last puff. That, believe it or not, was the metaphor Warren Buffett once used to describe his early investment strategy. Known as the cigar butt approach, it was a cold, numbers-only method focused on buying broken-down businesses for less than the cash on their books. These companies weren't pretty. But if you could get one final puff of profit before tossing them aside, the investment was a success. It worked. But only for a while. Buffett's early wins, including the original Berkshire Hathaway textile business, came from this approach. But as his ambitions grew, so did the limitations of cigar butt investing. It was labor-intensive, shallow, and unsustainable for building a long-term empire. Enter Charlie Munger, Buffett's trusted partner and intellectual compass. Munger challenged Buffett's obsession with dirt-cheap deals and planted a revolutionary idea: why not buy wonderful companies at fair prices, instead of fair companies at wonderful prices? This was the beginning of Buffett's transformation, from bargain hunter to brand visionary. The pivotal moment came in 1972 with the acquisition of See's Candies. It wasn't a textbook value play, it was a great business with loyal customers, a beloved brand, and a rich emotional connection with its buyers. This was Buffett's first real encounter with intangible assets, value you can't measure on a balance sheet, but that drives consumer behavior and pricing power. Munger and Buffett realized that a strong brand is like a moat, protecting the business from competitors and ensuring long-term profitability. But the brilliance of See's wasn't just in its name. It required very little capital to grow, yet delivered enormous profits year after year. That meant more free cash flow to reinvest into other ventures, a compounding machine disguised as a box of chocolates. This lesson would echo through Buffett's future decisions. In fact, it was the See's experience that gave him the insight to recognize the same power in another global brand, Coca-Cola. So here's the real takeaway: great businesses aren't just numbers, they're stories, moats, and cash flow engines. Buffett's shift from scraping cigar butts to nurturing world-class companies wasn't just a tactical upgrade, it was a mental revolution. As we move into the next chapter of this timeless investing journey, ask yourself, are you chasing cheap stocks, or building lasting value? Because as Munger reminds us, it's better to buy a wonderful company at a fair price than a fair company at a wonderful price. Key takeaway 3. The secret engine behind Buffett's billions, insurance float explained. In a world where most companies struggle to manage cash, Berkshire Hathaway faced the opposite challenge: how to deploy too much of it. With a portfolio of high-quality businesses gushing profits back to Omaha, Warren Buffett and Charlie Munger had a new dilemma: how do you reinvest an ever-growing mountain of cash without compromising discipline? The answer lay in a financial strategy so ingenious it flipped conventional wisdom on its head. Welcome to the power of insurance float, the quiet engine that fueled Berkshire's extraordinary rise. To understand float, imagine paying for a service now that you won't use for years. That's how insurance works. Policyholders pay premiums up front for coverage against future risks. Until those claims are made, the insurer gets to hold, and invest, that money. As Buffett famously put it, it's like getting paid to borrow money. The key is discipline. While most insurers chase premiums and sacrifice quality, Berkshire wrote only the right policies, those where the price of risk made sense. That kept the cost of float remarkably low, and sometimes even negative. This brilliant model was born in 1967 with the $8.4 million acquisition of National Indemnity. That humble purchase laid the foundation for a capital machine. Think of float as a bank account you get paid to use, except the money technically belongs to someone else. Unlike a bank, which must pay depositors interest, Berkshire's insurance float became a self-funding fuel source for long-term investments. This is what enabled Buffett to invest in juggernauts like Coca-Cola and American Express, building positions in world-class companies using capital that didn't cost a dime. Float only works with extreme discipline, and a bit of genius. Enter Ajit Jain, Buffett's insurance lieutenant and master dealmaker. Under his leadership, float grew from $17 million in 1967 to a jaw-dropping $70 billion by 2012. Munger nailed it when he said, "The basic idea is simple, use low-cost float to buy high-return businesses." That strategy wasn't just clever, it was transformative. In many years, customers literally paid Berkshire to hold and grow their money, flipping traditional finance on its head. Here's the deeper insight: float appears as a liability on the balance sheet, but at Berkshire, it became an asset more powerful than equity. It provided financial resilience, allowing Buffett and Munger to ignore Wall Street's noise and stick to their principles, even when the rest of the market was losing its head. This is the ultimate edge, a patient engine of capital that buys time, freedom, and focus. And as you'll soon see, that discipline would be critical as the financial world veered into stormier waters. Key takeaway 4. Why Buffett and Munger sat out the dot-com boom, and won. In a world drunk on tech hype, Warren Buffett and Charlie Munger were the sober voices in the back of the room. During the late 1990s, when anything with 𝐃𝐚 in its name could double overnight, most investors abandoned reason for adrenaline. But while Wall Street lost its mind, Berkshire Hathaway held its ground, backed by the steady, cash-rich foundation of its insurance engine. That capital base gave Buffett and Munger something most lacked: the emotional freedom to stay rational in irrational times. They didn't just miss the party, they deliberately skipped it. The reason? They refused to invest outside their circle of competence. Technology was evolving too fast, and they couldn't reliably predict which companies would stand the test of time. As Munger dryly put it, combine a great idea with bad behavior, and you still get bad behavior. While critics claimed they were out of touch, Buffett and Munger knew that sticking to what you understand beats chasing trends every time. But what really makes this lesson timeless is its emotional underpinning. How do you stay grounded when everyone around you seems to be getting rich? Buffett and Munger warn against envy, arguably the most dangerous emotion in investing. It lures even smart people into dumb decisions. You don't need to be a genius to succeed, Buffett once said, you just need the right temperament. They understood that the best investors aren't the cleverest, they're the calmest. That emotional discipline became even more critical as systemic risks began to quietly build. Buffett saw the 2008 crisis coming before most, warning of financial weapons of mass destruction, a now famous phrase about the risks hiding in opaque derivatives. The market had become obsessed with polished illusions, smooth earnings, slick presentations, and misleading metrics like EBITDA, which Munger famously called bullshit earnings. For them, spotting bad incentives and shaky ethics was just as important as reading a balance sheet. Ultimately, their patience became their superpower. While others got burned in the dot-com crash and the Great Recession, Berkshire was holding a fortress of cash, ready to act. The stock market is a device for transferring money from the impatient to the patient, Buffett said. This period reinforced a powerful truth: temperament, discipline, and clarity of thought are what separate enduring success from fleeting luck. Key takeaway 5. Why Buffett and Munger said no to the dot-com boom, and were right. In the frenzy of the late 1990s, when any company with 𝐃𝐚 in its name seemed to print money overnight, two voices remained remarkably calm. Warren Buffett and Charlie Munger didn't chase the hype, they stepped aside. While others were drunk on the promise of endless digital riches, Berkshire Hathaway held its cash, absorbing criticism for being out of touch. But what critics saw as hesitation was actually disciplined wisdom grounded in financial security, built on the solid, cash-generating foundation of their insurance businesses. Their restraint wasn't fear, it was clarity of principle. Buffett and Munger refused to invest outside their circle of competence, choosing only businesses they could deeply understand. The dot-com companies were promising, but unpredictable. When a great idea is mixed with unchecked euphoria, the result is still irrational, Munger noted. They didn't mind missing out on fads, they were playing a longer game, guided by value investing fundamentals rather than buzzwords and speculation. But here's the deeper truth: resisting temptation takes more than knowledge, it takes character. Buffett and Munger understood how envy can cloud judgment, especially when everyone around you seems to be striking gold. But giving in often means sacrificing logic for greed. You don't need a 160 IQ to be a great investor, Buffett once said. What you need is a temperament that neither derives great pleasure from being with the crowd nor against it. Their emotional discipline became their edge. While others chased trends, they stayed rooted in reason. And that clarity helped them see danger where others didn't. Long before the 2008 crash, Buffett was warning about derivatives, calling them financial weapons of mass destruction. These complex products hid risks that even their creators didn't fully understand. On top of that, corporate obsession with clean quarterly numbers led to deceptive tactics like manipulated earnings and the overuse of misleading metrics like EBITDA, which Munger bluntly called bullshit earnings. So what's the lesson for the rest of us? When hype takes over the market, when fear or envy clouds judgment, stay grounded. Follow Buffett and Munger's example, focus on what you know, resist the urge to chase noise, and prepare patiently. As others faltered, they were ready, sharp-minded and cash-rich, poised to act when reality reset the game. Buffett and Munger's.com strategy teaches us timeless investing discipline. Understanding how Warren Buffett avoided the tech bubble helps you build better long-term investment habits. Emotional intelligence in investing is what truly separates great investors from reckless speculators. In summary, for over 3 decades, Warren Buffett and Charlie Munger transformed their annual Berkshire Hathaway shareholder meetings into a world-class masterclass in investing and life wisdom. University of Berkshire Hathaway distills the essence of those meetings, capturing timeless lessons that have shaped some of the greatest financial minds and everyday investors alike. At its heart, this book is not just about money, it's about learning how to think clearly, act rationally, and live wisely in a world full of noise and temptation. One of the foundational principles taught by Buffett and Munger is the distinction between price and value. Price is what you pay, value is what you get. Their philosophy, rooted in Benjamin Graham's teachings, emphasizes buying businesses at a discount to their intrinsic worth, always with a margin of safety to guard against uncertainty. This approach instills discipline, patience, and humility, traits essential not only in investing but in life. Over time, Buffett and Munger evolved from chasing cheap stocks to owning high-quality businesses with strong brands and enduring advantages. Thanks to Munger's influence, Buffett moved beyond the cigar butt method, seeking one last puff from failing businesses, and instead pursued wonderful companies at fair prices. The pivotal acquisition of 𝐶𝐚𝐭𝐡𝐚𝐲'𝐬 illustrated the power of intangible assets like brand loyalty, setting the stage for landmark investments in Coca-Cola and others. The insurance float strategy became the engine powering Berkshire's expansion. By acquiring insurance companies like National Indemnity, Buffett gained access to billions in capital, money collected from premiums that could be invested long before claims were paid. Float became Berkshire's secret weapon, allowing them to fund massive investments without borrowing, and doing so at near zero cost. This financial backbone allowed Buffett and Munger to remain calm while others panicked. During the dot-com boom, they were ridiculed for sitting on cash. But rather than chase trends, they stuck to their principles, avoiding businesses they didn't understand. As Munger famously warned, mixing a good idea with excess hype still leads to irrational behavior. Their refusal to be swept up by fads protected them, and positioned them perfectly for opportunities others missed. Their greatest superpower wasn't intellect, it was temperament. Buffett and Munger repeatedly stressed that emotional stability matters more than raw IQ. While the market swung between fear and greed, they remained grounded, using volatility to their advantage. They viewed the market as a servant, not a master, always ready to buy when others were fearful and to sell when others got greedy. They also stood as sentinels against financial folly. Long before the 2008 crisis, Buffett warned about the dangers of derivatives and financial engineering. Munger called out misleading metrics like EBITDA, which he labeled bullshit earnings. Their integrity, insight, and willingness to speak hard truths made them not just investors, but guardians of long-term thinking and ethical decision-making. In a world obsessed with shortcuts and speed, University of Berkshire Hathaway is a reminder of the power of patience, principle, and perspective. It's a blueprint not just for growing wealth, but for building a life of substance and integrity. If this message resonates with you, please like, share, and subscribe to help spread these timeless lessons far and wide. And if no one told you lately, remember this: you are loved, you are worthy, and you are spectacularly capable of extraordinary things.